The next type of income that I want to address is the sale of business property. For most tax preparers, this concept and the form that reports the income, Form 4797, is feared and avoided, when in reality it can be quite simple. The trouble with the form is that it's easy to get lost in all the details and definitions, most of which apply in less than 1% of the situations. So, if you'll allow me, I want to share with you a short explanation and a few simple rules that will cover the majority of circumstances requiring this form. In your workbook, there's a detailed description of several IRS sections that describe how to handle gains and losses from the sale of business property. If your client is a farmer, you'll need to pay close attention to all of these sections. However, for any other industry, only 3 have significance. By far, the most common type of gain from business property is Section 1245 gain. This represents tangible, depreciable assets that were sold for more than their adjusted basis, but less than their original cost. An example of this would be if your client bought a computer for $2,000, and during the 2 years he owned it, he depreciated at $1,400, giving it a book value or adjusted basis of $600. Now he sells it for $800, giving him a Section 1245 gain of $200. This is also referred to as depreciation recapture, and the gain is reported as an ordinary gain to the extent of depreciation allowed or allowable. The second most common type is unrecaptured Section 1250 gain. The primary difference from Section 1245 gain is that Section 1250 gain applies to residential and non-residential real estate. However, the 1250 gain is calculated the same way as 1245 gain, limited to the depreciation taken to date. The third most common type of gain is Section 1231 gain, and may appear whenever a tangible, depreciable business or real estate business asset is sold. This is the portion of gain between the cost basis and the selling price. A sale involving Section 1231 gain generally has Section 1245 or 1250 gain with it. For instance, imagine that your client bought an apartment building in 2001 for which she paid $150,000 and began depreciating it immediately. She sold it in the current year for $200,000. Section 1250 gain is the amount of depreciation she has taken on the building since she purchased it. We call that recapture, and the $50,000 difference between the purchase price and the selling price is Section 1231 gain. Section 1231 gain may receive the preferred treatment that gain on long-term capital assets receives, which we discussed in Session 5. Now, if your client is in the agricultural business, you will need to pay closer attention to the other sections listed in your workbook.